So thank you everyone for joining Heritage Financial's Fall Market Outlook for 2024. I'm pleased to be joined by our Director of Portfolio Management, Michael Waldron, today. And today we will walk through the economy, financial markets, even talk a little bit about politics to share what we're thinking about markets. So a little bit about Heritage Financial at a glance. We recently crossed $3 billion in assets under management for the first time in the firm's history, which is a nice milestone. We have clients in 36 states, 46 employees, and our mission is to make a positive and lasting financial impact on the people in our lives and those we serve. So I'm going to run through a few slides on the economy as a backdrop. So as you probably know, inflation has been the story of markets for the last few years. As we came out of COVID, inflation spiked. At first, it was viewed by the Federal Reserve as transitory, and then it proved to be a little stickier and wasn't going away. And inflation got up to close to 9%. And then the Fed started combating inflation through Fed policy by increasing interest rates, and inflation has come down. It hasn't gotten down to their 2% target, but it's close, and the trajectory is there that it continues to decline. So inflation's rising at a slower and slower pace. So it looks like they will hit their 2% target. Up top, we're looking at CPI. Another measure of inflation that the Fed prefers to use is the PCE in the bottom left, and you can see this measure is around 2.5%. So again, getting close to their 2% target, not quite there, but close. And then you can look to financial markets where you look at tips and treasuries and look at the difference between the two as far as the yield, and that tells you what the market is expecting. And the market has confidence in the Fed. The market is pricing in inflation over the next 5 years to be 2.0%. So the market thinks the Fed's going to get there. We're almost there. So inflation, the picture is getting much better. And the Fed has a dual mandate. So one part of the mandate is price stability or inflation, and the second is employment. So when we look at the employment picture, the labor market, what we see is the unemployment rate has been rising. It's risen up to 4.3% from a low of 3.4, so 0.9% increase in unemployment on a workforce of about 160 million people. That's roughly 1.5 million people who have become unemployed over the last couple of years as we've seen unemployment tick up. So that's of concern to the Fed. And seeing inflation come down, meanwhile, unemployment tick up, this brings more of a balanced focus on their part, which is why they recently cut rates by 50 basis points and are expected to continue to cut rates because cutting rates is stimulative, helps the jobs market, which they think needs a little more help now. Whereas inflation, higher rates are there to combat inflation, and that's not as big of a concern. And one other picture or piece of data that we think the Fed is paying attention to that hasn't gotten many headlines, but we think it's worth noting is credit delinquencies. So this is looking at early delinquencies on loans, auto loans, credit card loans, student loans. Student loans are okay. The level of delinquencies is low and has stayed low, but there has been a concerning change or rise in the level of delinquencies in both autos and credit cards. And you can see, looking at credit cards, for example, up to 9.1%. We haven't been at 9.1% since back around 2010, 2011, when we were coming out of the global financial crisis. And the same goes for autos at 8%. We haven't been at 8% on autos back since about 2010 or 2011. So these are elevated levels, and it shows some weakness in the consumer. And in the United States, the consumer is the majority of GDP. So it definitely bears the Fed's attention and our attention as far as looking at the economy and looking at the balance between, is the economy too strong and too hot and inflation too high, or is it starting to cool, and seeing concerns with unemployment rising, delinquencies rising, and that's where we're seeing much more of a balanced focus by the Fed, which we think is appropriate. So with that backdrop, I'm going to hand it over to Michael to talk about valuations in U.S. markets.
Perfect. And yeah, I think backdrop is the perfect word there. So when you think about the economy, yes, that's important, but we're all here and we're thinking about our investment portfolio. And when you think about your investment portfolio, the economy is important. It rhymes with what happens in financial markets, but it's not the whole story. So let's dig into financial markets. The first thing I wanted to do was decompose price to earnings ratios. So you'll often hear the industry talk about PE multiples. Well, let's actually go a step more granular. Let's get the gross data and let's take a look at that. So on this chart, I have earnings that's in the dark blue line. and the price of the S&P 500, that's in the light blue line. And we go back to kind of the pre-pandemic period, you can see earnings rising nicely, prices rising nicely, and then you obviously have the pandemic disruption where earnings come down. Now, after that kind of blip, you had really strong earnings growth over the course of 2021 to the beginning of 22. And you saw earnings grow in excess of what you saw kind of for price growth. So you actually had equities looking reasonable at that period of time. Now, as you go into 2022, you have earnings come down. And as earnings came down, you saw prices react and react more than what the fundamental earnings came down by. So while earnings were falling, you actually saw price react even more. So as we hit the fall of 22, we were very excited about equities. This is when we're talking about we want to be above our baseline volatility because we think risk assets are priced attractively. So stepping into equities because price seems to maybe have overreacted compared to what happened to earnings. Earnings started to recover, but at a slow pace, and prices recovered very rapidly. So we're off of a couple of very, very good years worth of return. If you go back to the fall of 22 to the fall of today, we've seen a very material increase in prices, really good equity market returns. But a note there is earnings have not recovered to the same extent. So a couple of things to pay attention to here. If you look at the 2021 earnings number, 197.87 for S&P companies, we're lower than that today. And yet if you look at the price of the S&P 500, it's above where we were entering 22. So kind of objectively, if you look under the hood at this, you'd say when I entered 2022, I actually looked a little bit better from current operations of companies compared to where they're priced today. And that's why we've been a little bit more constructive on fixed income starting at the beginning of this year. So now let's talk about this from an asset allocation standpoint. So you take those two raw pieces of data, the earnings of the underlying companies in the S&P 500 and the price of the S&P 500, you divide those two. So how much earnings do you have per unit of price? And that gives you the earnings yield, which is that blue line. Higher earnings yield is generally better. Then take a look at that relative to what you could get on a 10-year US Treasury. So what do I get for taking the risk of buying into companies' operations versus what I could get as a risk-free interest rate from the government? So if you look back over time, you can see typically you get a higher yield on current operations than what you would get on a Treasury. And that's somewhere in the 1 to 2% range is a very normal premium. So you'd get that on current operations plus profit growth, and that gives you the higher return on equities. Now, what's interesting here, again, is you see through 2022, prices reacted more than earnings. So as earnings came down, prices really got depressed. And your highest earnings yield was actually in the summer of 2022, which was not a very good time for markets. At the end of 2022, again, that was when we were getting really excited about increasing equity allocations. So sometimes, again, when you look at the economy and you look at financial market pricing, they're a little bit different. They rhyme, but they're not right on top of each other. So what we've seen recently is while earnings have recovered somewhat, that's been a lot slower than the pace of the increase in the price of the S&P 500. So down grinds that earnings yield number. In the meantime, you've seen fixed income markets obviously come up. And as we hit the fall of last year, 2023, you actually saw the 10-year earnings yield start to exceed what you could get on current operations divided by price of the average S&P company. That's positive for fixed income. So the shaded area is the difference. You see that that's turned negative. And while rates have come down somewhat, price has continued to move up on stocks at a greater clip. And we still remain at a point where you can get more in a treasury than what you would get if you just continued today's earnings of the S&P 500 companies into perpetuity. So your entire stock price is really predicated on growth. Maybe that'll happen. I think we should all hope that that'll happen, and you should have growth and profit over time. But it gives you a little bit of a cautionary tale. Right now, on a relative value basis, fixed income looks fairly attractive compared to equities, and equities, in order to produce a much better return, will have to hit extremely good growth numbers and profits. So fixed income, this is an asset class where you can forecast yield with a little bit more confidence than some other asset classes. So this looks at the US 10-year Treasury yield, and then it looks at the subsequent 10-year return. And look at how highly correlated those two are. So as yields have been coming down and down and down over the course of the past multiple decades, the forward-looking returns on fixed income and the forward realized returns on fixed income have come down. And then you saw the inflection point. So as the Federal Reserve changed policy and we've seen interest rates start to increase materially starting in 22, you now have the opportunity to buy into fixed income and to get yields that look back like they did in the mid 2000s, which was a fair area. So positive there on fixed income. So one other way to look at this is, where is the 10-year US Treasury yield compared to its long-term history? So if we look at the average yield over the past 20 years, it's 2.89, and we're in excess of that, just shy of 4%. And if you look at the S&P 500, so stocks, how are they priced compared to history? And if you look at the average PE multiple on the middle line, you can see that we're well above that. So stocks are slightly more expensive. When you think about this from a portfolio standpoint, stocks are more expensive than they historically have been. Fixed income's providing a higher yield. Our signals are relatively positive towards fixed income playing a full role in portfolios. So Bob, I kind of gave the doom and gloom there. Maybe you can talk a little bit about why we would still have equity allocations for our clients given that.
Yeah, thanks, Michael. Definitely making the case for fixed income in portfolios. So given that, looking at the stretched valuations in the US, at least above historical averages, and then people can have many reasons to be concerned or want to be risk averse from time to time. It's tempting to say, why don't I get more defensive? Why don't I just go all into bonds or much heavier into bonds? So a couple points to make. One, I think this is an interesting chart. It shows the distribution of U.S. equity market returns in 10% bands, ranging from -40 to -50 all the way to +50 to 60, and the count in calendar years to measure the frequency of these outcomes. And what you see is that the most common outcome is a 20 to 30% gain in stocks. And that your first reaction, if we did trivia, people probably wouldn't get that. It seems a little high. And the reason is because you get these -10s, -20s, -30s for the stock market to average out around 10%. You need to have a good amount of 20s and 30s in there, and 30s and 40s even, knowing that you get these negative years as well to get an average of 10. And what's interesting is 10 actually has never come up in this data set. As you can see, in the 0 to 10, it gets as high as 9.8, and then the 10 to 20, it starts at 11.14. So we've never had an S&P, or excuse me, this is the CRSP index, but US market with a 10 handle on it, even though that's pretty close to the long-term average. So this gets to the perils of market timing. If you were to say, I'm going to get out of stocks, and what's that going to cost me next year? Well, we could say, well, on average, it might be about 10%, but you could pull the 20 to 30% marble out of the hat, and that's what you get next year. You're not going to get an average outcome. You're going to get a singular outcome, and there's a lot of very positive singular outcomes that come with investing in the stock market. And one other thing we hear in the headlines, the media likes to point out when you hit new all-time highs, and frequently paints it with a kind of bearish picture, like, uh-oh, look out, the market's at an all-time high, implying that, what goes up must come down. But the thing is, the market does climb over time. It does go up. It does regularly set new all-time highs. And there's a factor that academics and professionals call momentum or trend, which basically means winners keep winning, losers keep losing. If you think about it, by definition, a bull market is a time series of positive outcomes, and a bear market is a time series of consecutive negative outcomes. And when you hit new all-time highs, how does the market do on average? It actually does a little better than average over the next year. So after a new all-time high, 1 year forward looking, the return on the S&P is 13.7%. Very strong return. So by itself, nothing to worry about when you hear the headline that we're at a new all-time high. It actually means The market is pretty optimistic, sees a lot of good things happening. That's why it's where it is. And as investors, that's not at all the reason to run from it. But Mike, what about index concentration? That's getting a lot of headlines these days.
Yeah, I think it's a really important theme. When you think about an index fund that owns all companies at their market cap weights, how diversified are you, and is that the best approach? So when we talk about markets and market returns, well, what about the construction of the portfolio and how that might look relative to the overall market? So here, put together a visual that I think is compelling. When you look at the Magnificent Seven stocks, so that's Apple, Microsoft, Nvidia, Google, Amazon, Facebook, and Tesla. And yeah, I'm not using their new names. The Magnificent Seven names, and you total those up, they make up $15.89 trillion in market valuation. So to put that kind of scale into context, this fits from an area standpoint how other companies would fit into a portfolio. So take 20 of some of the largest name brand companies in the S&P 500, from your Coca-Colas and McDonald's, to your Exxons and Chevrons, to your Visas and American Express, to Johnson and Johnson and Disney. So all sorts of names that have been very, very large companies and should be in a well-diversified portfolio. Put those all together, and that makes up about 30% of the weight that just those seven stocks would in an index fund. I think when you think about that in context, that's not the diversification that you necessarily would want. If you were thinking about optimizing from bottom up, you wouldn't want a portfolio to have that much concentration in a few names performing. So we do break market cap weight, and we look different than it. So if you look at those top seven stocks, so take the top 10, add three to it, what's the current pricing of them? So the current pricing of the top 10 is a 28.3 price to earnings ratio. Take the 490 below that in the S&P 500, and the PE ratio is 18.4. So when we talk about maybe the market being a little bit expensive, that's concentrated in just a few companies. Go ahead and break that market cap weight, have more of the remaining 490 than an index fund would, and all of a sudden you're not looking so expensive relative to history. So to Bob's point, we don't have to get overly caught up on we're priced a little bit more expensively than average in the whole market, because we're not owning market at market cap weight. We're owning it in a much more prudently priced manner, which is consistent with higher returns. In terms of, is this always the case? The answer is no. So if you look over at the top right, market concentration weight of the top 10 stocks, we're at an all-time high, 35.5% as of August 2024. You're generally down somewhere around 20%. So we're much more concentrated in a few names. That means that if you just invest in an index fund, a few companies are driving what your overall portfolio performance is. And we know from a diversification standpoint that that's not a great approach, and with outcomes that are much wider. And then if you look at the contribution of earnings, this is kind of an interesting contrast. We have been at this level of concentration in earnings for the top 10 companies multiple times before. So while the concentration is really high today, their earnings are not necessarily justifying that. So a lot of the price of the stock market right now is on growth expectations of a few stocks. Hopefully that plays out to some extent, but I think the handicapping exercise is you'd want to avoid that somewhat, back off of that a little bit, and build a more robust portfolio in stocks. So Bob, I know looking under the hood there is interesting, but let's get to what everybody I'm sure wants to talk about. We're a little bit over a month away from an election, so let's talk about the election and how we think about that from a portfolio standpoint.
Yeah, we have an election in 5 weeks, and I know we received a number of questions relating to politics. So we're going to talk about politics. And before I dive into it, just first a little disclaimer that we are looking at politics solely through the lens of economics and financial markets. I know there are a lot of key issues that come up in an election, and we're investment advisors. So we're talking about financial markets here as it relates to politics. And we do have slides, I'll get into them. But first, just to kind of cut to the bottom line, we believe that you should not change your portfolio as a result of an anticipated election outcome or an actual election outcome. We've looked at this many different ways. We've seen a lot of studies, and we think the evidence is pretty strong that while elections matter, they do not should not lead to behavior of getting in, getting out. So with that, I'll run through a couple slides, trying to be as balanced as possible. I might even try and have a little fun with this, so please bear with me. But if I'm talking to, say, we'll start with my Democratic friends, and we're looking at a chart of um, previous presidents. Well, this year's Republican candidate has been president before. And when he was, the stock market did pretty well. So from a stock market standpoint, I'm not seeing evidence to be concerned about that particular outcome. And then if I'm talking to my Republican friends or clients who are concerned about a Democratic outcome, well, if you look at how the stock market has done under Democratic presidents, the answer is pretty darn well. In all of these blue bars, you're around 10% every year. So I'm not seeing evidence that either call it a red win or a blue win in the presidency is something to be concerned about when looking at this. But it is important to know, be aware of that there's more than one election in 5 weeks. There's the president, but we also have Congress that has an election cycle as well. And presidents or presidential candidates run on a platform where if I'm elected, I'm going to do X, Y, and Z, and they make all these promises, but they have to deal with Congress, fortunately. And what you see in reality is a lot of what they say is just talk, and then when they get elected, as long as it's not call it a blue sweep or a red sweep, they have to negotiate to get what they want across. So that's what this slide is looking at. It's looking at the annual S&P 500 returns under a Democratic president and then under a Republican president, and the makeup of Congress in these environments as well. So is it Democrat president with a Democratic Congress divided, or Republican Congress, et cetera? And in the middle bar is it's the average return in these different scenarios. And on a high level, what you see is that the market does pretty well regardless. Some might look a little better than others, like a Democratic president with a divided Congress historically has been a good outcome. You have balance of power there and required negotiating. The Republican side, the better scenario historically has been all red. Why that is, I don't know why it's not called the same for a Democratic president, but we're not seeing data here that says that any of these outcomes mean go to cash. So this is about as deep as we'll get into politics. But I just encourage our clients, our audience to keep your politics and your portfolio separate. They both matter, but don't confuse the two or make serious portfolio decisions based on election outcomes. So that's what we had in prepared comments. We have some questions we can jump to. And if anyone has any questions, you can also submit those. Looks like through the chat feature is what I'm seeing. So to start, Michael, one of the questions submitted in advance was about bond funds. Should you buy bond funds as part of a portfolio plan in a declining rate environment? What do you think about that?
Yeah, there's a heck of a lot of nuance to that. So I think sometimes when you take a Federal Reserve policy of we're decreasing the federal funds rate as you come down by 50 basis points, that doesn't necessarily tell you what's going to happen in an overall bond fund that already has baked in what it expects short-term rate policy to be. So as an example of that, as you look over the course of the summer where things were hold steady, you saw fixed income rates come down and you saw really strong fixed income returns. So bond funds did great over the course of the summer. And as you've looked since the Federal Reserve decreased the short-term federal funds rate by 50 basis points, you've seen an increase in term rates. So I think when you look at fixed income overall, stepping back to some of the data and information that we went over, you have a very reasonable yield that you can get in fixed income that looks relatively attractive to what you can get in equities right now. It plays an important part in a diversified portfolio to bring down the overall variability of outcomes and to provide an asset class that you can rebalance from or use to source liquidity from. So I think you certainly should own bond funds, and I think us being in kind of a loosening monetary policy doesn't necessarily mean anything for that asset class specifically.
All right, thank you. We just had a question come in about interest rate policy and whether or not it will be influenced by the election results. So well, I'll take that. The Fed is definitely in a rate reduction cycle. The market seems about split if the next move is going to be 25 or 50 basis points, and the following one after that, it's the same question. It looks like 25 or 50. So as far as exactly where they're going to end up, we don't know, but they are cutting rates, and we'll probably see them cut eventually by 1 to 2% over the next year or so. So rates are going down. The Fed, as far as it relates to election results, the Fed is supposed to be independent, not influenced by politics, and I do have faith that they will follow that. And they basically have tended more to make enemies with whoever's in office, and I don't see them being influenced by election outcomes. Outlook, Michael, we've talked about this a lot. Outlook on residential home prices. That was a participant question. What do you think about that?
Yeah, that's kind of an interesting one. I think that is one where you do have to pay attention to policy, and you don't want to fight where policy's aim clearly is. So when we've looked at inflation and we've looked at a lot of the pain and where prices have gone up, the prices of shelter are certainly in the crosshairs there. So I think explicitly with the increase in rates that we've seen, it was to try to slow down the increase in property markets and in rent. So to me, if I were looking at property prices, I would say all else equal, I wouldn't fight where policy has been. And I think that those sort of assets are more likely to have a lower return forward looking than what we've seen in the past.
Yeah, I agree with that. I think that's well said. And the other thing that you've brought up to me is housing in most markets should be anchored on incomes. And we've seen through a combination of higher housing prices plus higher mortgages, housing affordability has kind of run away from the average income. So it should be anchored. People need to be able to afford housing. So from this point to continue to see appreciation well above the Fed's inflation target, I would not count on. Certainly a possibility, but seeing that slowdown is something that I think we both expect.
Great.
We have a question. What is the comparative outlook for Latin American versus Chinese versus Indian stocks, and why? So I'll take that, looking at three different emerging market regions. Latin America, it's basically, I think 55-60% Brazil, 30% Mexico, and then slivers of I think Chile and Argentina, and then China and India. So Latin America is pretty heavy in natural resources, oil, iron ore, materials like copper. So there's inflation sensitivity there. There's also political risk. So part of it depends on where inflation heads. China and India, those are bigger markets, and that's more interesting. They're actually pretty much polar opposites right now as far as markets go. India basically couldn't be better right now. The markets love India. It has good demographics, more stable politics. It's growing nicely, whereas China is almost the opposite. The demographics from their one-child policy years ago are kind of setting themselves up for trouble. Growth has slowed. Politics there are a little more challenging. But what you see is the market's smart. The market knows this. So as a result, the Indian stock market is trading at about 18 or 19 times earnings, and the Chinese market's half that, about 9 times earnings. If you look at price to book, the Chinese market's 1 times book, Indian market's more like 2.5 times book. So it's like expensive and looks great, or doesn't look good at all, but cheap. And we don't come down on pick one or the other. It's both and diversify, and they just have different risk return profiles. So sorry, a bit of a long answer, but that's how we look at both of those markets. Historically, value, which in this case would be China, has done better. And the Chinese stock market, for those who don't know, is up about 25% over the last 2 weeks. their government has had enough and finally came out with a broad stimulus plan, and the markets reacted favorably. So that things like that tend to happen where you have positive surprises when the outlook is very bleak. So we are seeing a nice recovery in China. A question just came in. There seems to be a lot of geopolitical issues around the globe. How do you think the current and increasing level of conflicts will impact the U.S. economy and markets? So it's a pretty broad question. Michael, you want to take a stab at that?
Yeah, sure. I mean, I think if you just want to paint a broad brush on things, as you get increases in kind of active wars and violence, that's not good for anybody. So it's not good for businesses, it's not good for markets, it's not good for the certainty of outcome. So markets certainly like peace and stability, and to the extent that you see, unfortunately, more shooting wars, I think that all else equal, that's bad for markets.
Yeah, markets do not like uncertainty. You add uncertainty, all else equal, prices should go down a little bit to adjust for a range of outcomes, like you said. So at a humanitarian level, it's terrible to see, and it's not good for markets either, having political instability across the world. We had a question submitted in advance about dividend-focused funds. I know something we've talked about many times. Do you want to take this one, Michael? Your
Yeah,
take on
sure.
dividend-focused ones?
Yeah, I think when you kind of get into the theory on this, there really is nothing that says that you would want a fund that pays more dividends. So when you think about a company, do you want a company that, let's say, makes earnings and then reinvests into the business because it has profitable opportunities? Or do you want one that pays it all out and doesn't reinvest in the business? So just on that standpoint, it's not necessarily clear that a dividend payout is better. You wouldn't want to be paying out dividends if, let's say, you had profitable future business opportunities and you then had to raise equity capital. That wouldn't make any sense. So retention makes sense for good, strong, growing, healthy businesses. In terms of other businesses, how do you get money back to shareholders? Now, dividends essentially forces a taxable event on people. Instead, if you're a company, you could repurchase shares, and that allows people to take money out and you retire those shares. And that's actually a much more tax efficient way where people who want out get out and nobody else has a taxable event. So all else equal, you'd rather do buybacks. Therefore, dividends, it's kind of not a relevant topic. So I think companies generally that are more intelligent about how they're treating their share owners would tend to buy back shares instead of pay high dividends. And therefore, I wouldn't focus on dividends as a criteria for being a good or bad investment necessarily.
Well said. Thank you. A question just came in. What effect will a prolonged port strike have on markets? So we've talked about this internally, and when you step back and think, what's the right price of a stock? What should Apple be priced at? And the financial textbook answer is the present value of all future cash flows for the life of the company. So estimate how many iPhones and products Apple will ever sell, use a discount rate, and that's the price. So when you take something like a port strike, even if it's prolonged, which was the word used in the question, now what's prolonged mean? Are we talking weeks, a couple months? Using Apple as an example, what percentage of the total future profits of Apple's existence will be lost as a result of that? My math is it's not very material. Markets do tend to be emotional, do tend to overreact a little bit, so you could see some volatility. But really, for a long-term investor, we don't look at this port strike as something that you should be worried about. We had another question submitted in advance. Which areas of the stock market should a recent retiree be in for defensive purposes? So with that, I'd go back to the slides Michael had on index concentration and almost flip it to what areas you should not be in, and I would not be overexposed to technology. Technology has done well. I could see how a portfolio could become overweight technology if you just bought a bunch of stocks and just kind of let it ride. But some of those valuations have become stretched. So I wouldn't focus on, say, like dividend paying stocks where you own a bunch of utilities and telecoms, but more just focus on diversify. and don't be concentrated in any one or two sectors. We're big believers in globally diversifying, looking at valuations, but not getting too narrow as far as I'm a retiree and I need to own a certain flavor of stocks.
Yeah, I agree, Bo. That's the thing to not be is not diversified. So you don't want to have things that could end up in a permanent loss for you over your investment horizon. And when you look at an index fund right now, it is concentrated in technology and the Magnificent Seven. And you could feasibly have those companies have a bad run for a longer period of time. So I think being able to break and diversify away from that, as Bob said, not just US, make sure that you have international too. When I look over the past 3 years, the average member of the NASDAQ fell 45% at a point in time. So when you think about, again, concentrating especially in more expensive tech and some of those growth names that have been bandied around with AI, those are the sorts of things when you're a retiree that can cause instability in an equity allocation. And I think our methodology for building a portfolio is try to insulate you from those more acute risks of concentration.
And one of the questions submitted in advance, will the tech and chip sector rebound by the end of 2024? So when I read this, I'm thinking this is submitted by someone who owns Intel, because otherwise the tech sector as a whole has done well. The chip sector as a whole has done well this year. Intel's been in a world of hurt for a while. They probably need some change of leadership there, but I'm not going to get into a single stock name. But overall, the tech sector has been strong in the U.S. broadly, and chips led by NVIDIA have been strong. So no concerns there. And that's what we have for questions. So thank you, Michael, for joining me today. And thank you to our clients and audience for joining our market outlook today. Have a
Bob,
good
maybe
afternoon,
it's
everyone.
a fun way to end on this. If anybody has something else to submit, I was just thinking about the politics question, and I had heard something that I thought was compelling and just good to keep in the back of your mind. So if you go back to 1948 and you invest $10,000 in the S&P 500, if you sell out every time that a Democrat is president, so you just invest for the Republican administrations, you'd have $300,000 today. If you sell out every time that a Republican wins and you just invest during the Democratic administrations, you have 1.2 million. Well, if you invest through both, all of the Republican and Democratic administrations, you have 38 million.
Oh,
So you can take that 300,000 or that 1.2 million, and the thing wasn't to follow the politics, it was to be invested for the whole period of time.
great
So
bottom line, Michael. I hadn't heard that one. That's a fun stat. So stay invested and ride out the politics is the bottom line. So, all right. Thank you everyone for joining today. Have a good afternoon.